Hi, everybody. It's Peter Schiff. It is Friday, November 22nd, 2013. Earlier this week, the Federal Reserve released the minutes from its October meeting. Upon release of those minutes, the markets and the media immediately concluded that a taper is imminent. Maybe it'll happen as soon as December, but surely by March, the Fed will be tapering its quantitative easing program. Now, if you actually read what's in the minutes, that's not what they reveal. At no point did the Fed commit to tapering anything. All the Fed did was speak about the possibility that they might taper if economic conditions warranted the tapering. So in other words, it's just more talk. It's more bark and no bite. I said this many times. This is going to be like waiting for Godot. The Fed can talk about taper, but the only thing they fear more than tapering is admitting that they can't do it. Because if they taper, then the recovery will fade. In fact, if you look at the yield on the 30-year U.S. Treasury, where it is today, it's exactly where it was back in September when the Fed surprised everybody and didn't taper. And if you recall the Fed's reasoning for not tapering, they specifically cited financial conditions which they said had tightened. And they were referring to long-term interest rates. Well, they went down when people believed the Fed wasn't going to taper or after they disappointed, but now they've ratcheted all the way back up. The financial conditions are just as tight now as they were when the Fed said that they couldn't taper. Now, if the markets continue to believe, if they continue to take the Fed's taper bait and feel that a taper is imminent, the interest rates on long-term government bonds are going to rise even further. Now, if they continue to rise, by the time the March meeting comes around, financial conditions will be a lot tighter than they were back in September. Well, if the Fed couldn't taper in September because financial conditions were too tight, how are they going to taper in March or even sooner if financial conditions are even tighter? The fact of the matter is they have no intention of tapering. The markets still haven't figured that out. You know, despite the fact that today, Dennis Lockhart, who is the president of the Federal Reserve Bank of Atlanta, was on CNBC, and this is what he said: "We won't taper our bond buying until the economy is ready. We won't taper until the economy is ready." Well, what kind of commitment is that? I mean, I think he knows the economy will never be ready. I mean, ready is always subjective. When will it be ready? You know, it's like a drug addict saying, "Yes, I'll stop taking drugs when I no longer need the drugs to stay high." Well, you always need the drugs to stay high. We are high on monetary stimulus. We are high on QE, and we will always need that drug to stay high. In fact, we will need greater doses of that drug to stay high. That is the truth that the Federal Reserve is too afraid to admit. In fact, Ben Bernanke this week was trying to describe the QE program, and he compared it to a Saturn V rocket ship that has many stages. You know, when you have a rocket ship, you have the first stage that, you fire the rockets to get escape velocity. But then when you exhaust the fuel and the spaceship is higher up and it doesn't need as much thrust, you jettison that spent stage, and now you ignite the new engines, and the spaceship keeps on going until it eventually, escapes the Earth's gravity and goes into an orbit, or maybe continues on to the moon or whatever it was doing. And so he gave the analogy that QE is like, stage one. It's not. It's got nothing to do with stage one. I mean, one of the main difference is, when you launch those rockets, when you drop the stage, it's gone. It's no longer having to be dragged up by the remaining stages. But QE, the $4 trillion balance sheet, that doesn't evaporate into the atmosphere. That's still there, dragging down this rocket ship. It's going to keep it. In fact, the rocket ship never even got off the launch pad. That's the correct analogy. And by the way, QE1, QE2, what happened to those stages, right? As they were jettisoned, we needed bigger stages. It's the opposite of the rocket ship analogy. See, the fact is that it is impossible to create a viable, self-sustaining recovery with QE. I keep saying it, if an economy lives by QE, it dies by QE, but no one seems to be able to figure this out, despite how glaringly obvious it is. In fact, if the Fed were to pull back, right, if it was to taper and then eventually stop buying bonds, it's not only the absence of Fed buying that would crush the market. Private buyers, particularly the leveraged speculators, why would anybody buy a 10-year Treasury yielding, 2.8%, or even a 30-year Treasury at, 3.9? Why would you do that? The only reason you would accept such a low yield is if you were confident that there was no risk. Well, why is there no risk? Because the Fed has got the backstop, right? It's the Bernanke put. The Fed is there buying bonds, putting a floor under the market. It's a safety net so that you can take all this risk, rather you don't take all this risk for this minuscule return. But if the Fed is not going to be there with that safety net, if it's basically, hey, buy these low-yielding treasuries at your own peril because, if the price drops, you're going to lose a lot more than the yield would have been, well, then the private buyers aren't going to be there. So if the Fed steps back, it's not only the Fed buying that's missing, and the Fed is the biggest buyers of bonds out there. Not only is the Fed buying gone, but the private buyers aren't going to be there either. But here's the biggest bombshell of the week, maybe of the year. While everybody was focusing their attention on what the Fed didn't even say, right? They were pretending the Fed said they were going to taper, even though they didn't. So while everybody was focusing on stuff the Fed didn't say, nobody paid attention to what China actually did say. Because China announced the mother of all, tapering. China finally came out and admitted that a further expansion of their foreign currency reserves is no longer in China's interest. Now, expanding their foreign currency reserves hasn't been in China's interest for a long time. It's just that now they finally come out and publicly admitted it. Now, what does that mean? If China isn't going to expand its balance sheet anymore because it's not in its interest, that means it has to stop buying treasuries. It has to stop buying mortgage-backed securities, the same securities the Federal Reserve is buying and is threatening to taper off. Well, if China stops buying, they've tapered down to zero, right? They've gone cold turkey on it. They're not just going to wean themselves off it. Because even if they were just to buy fewer treasuries than they're buying now, their balance sheet by definition would then be expanding. They've just said that it's not in their interest to expand their balance sheet. So unless they want to do something that is admittedly contrary to their interests, then they've got to get out of the bond buying business. Now, I think not only does China think that expanding its balance sheet is not in its interest, I think that maintaining the current size of its balance sheet is not in its interest. The balance sheet is too big. I think China wants to unwind. I think they want an exit strategy. Now, some people might think, well, does that mean that China has to go and dump its bonds into the market? No. Thanks to Operation Twist, which remember I called Operation Screw, and for good reason, and here's one of the reasons. I think when the Fed was selling its short-term treasuries and buying all those long-term treasuries, China was on the other side of that trade. China was selling the Fed its long-term maturities, long maturity debt, and swapping it for the short stuff that the Fed was selling. So now China has a very short maturity for the treasuries that it holds. And if it makes the decision that it doesn't want as big a balance sheet, that it wants its balance sheet to shrink, it doesn't have to sell any of the treasury bonds. It just simply allows them to mature. You see, that's why we're screwed. Because when the treasury bonds that China owns matures, where is the government going to get the money to pay them off? They're going to have to sell even more bonds. But wait a minute. If the Fed is tapering, who's going to buy those bonds? And again, if the Fed is tapering, where's the private sector demand going to come from? The market would fall through the floor. See, the truth is, if China means what it says, the Fed is going to have to back up the truck. I mean, not just not taper, but they are going to have to significantly increase the amount of monthly QE that they do in order to pick up China's slack. That's what's going to happen in 2014. Even if Janet Yellen surprises me and tapers, which I don't expect her to do that, but if she does, she's going to be untapering but quick because she's going to have to pick up the missing demand that the Chinese are no longer supplying. And believe me, if China stops buying, a lot of other foreign central banks are also going to stop buying, because the only reason they are buying is that because they're in a competitive devaluation with China. But when everybody surrenders in the currency war, America loses. In fact, not only did China state that they don't want to expand their balance sheet, they publicly stated that they wanted to let markets determine exchange rates. Well, that's what happens, because the reason that China has such an enormous balance sheet is because it's had to accumulate all these dollars to suppress the exchange rate of their currency. So when China stops expanding the balance sheet, that also means that the Chinese currency is going to appreciate, and China has said it will allow that appreciation to happen, certainly at a much faster pace in the future than it has in the past, and ultimately just leave it up to the markets. That means the dollar is going to get crushed against the Chinese yuan, as well as a lot of other currencies that are set to rise with yuan. That is going to dramatically undermine demand for treasuries, demand for dollars. What does that mean, right? That means the Federal Reserve, again, is going to have to buy a lot more, but it also means that U.S. consumers are going to have to pay a lot more for the things that they buy, because if the Chinese are going to be rewarded finally with a stronger currency, they're going to have more purchasing power. More of what China produces is going to stay in China, and more of the money the Fed creates is going to stay in America. So now China is going to get some badly needed deflation, because they're going to see falling prices and an appreciating currency, and we're going to get hit with a tsunami of inflation, or rather rising prices, as a result of all the money staying in America but the goods staying in China. That is going to further impede the economy. In fact, if you look at a chart of oil prices have been correcting up until this week. They now had a pretty nice move up. I think we've broken the short-term downtrend. And so not only are consumers having to deal with higher interest rates, but they're also going to have higher fuel bills again, which will be an added drag on the economy. And despite all of the supposed good news that's out there coming from the government, look at all the terrible news we got this week from the retailers. Walmart came out and said this is going to be the worst holiday season since 2009. Well, if the economy is so much stronger than it was in 2009, why don't the consumers have money to buy gifts? In fact, Thanksgiving, AAA came out this week and said that Thanksgiving traveling is going to be off 1.5% from last year. Well, if the economy is stronger, why are fewer people traveling? I mean, they can't afford to travel, but why not? Because the economy isn't stronger. Yes, the stock market is higher. Yes, the real estate market is higher, but that's got nothing to do with a good economy. It's got everything to do with bad monetary policy. And unfortunately, the Federal Reserve is going to continue this bad monetary policy and augment it. Meanwhile, the markets are totally oblivious. When the Fed released its minutes, gold was down like $30 that day, because the gold traders believed that the minutes meant that there was going to be tapering, that there was going to be some kind of tightening. In fact, the bearishness in gold, because I think gold dropped maybe better than $40 on the week total, but bearishness rather is now at the highest levels that it's been of this decline. People again are taking that bait. They're believing the rhetoric, and they're not looking beneath the surface, because not only is the Fed not actually saying it's going to taper, but if you understand the fundamentals, then you realize that it can't. I mean, there were all these articles this week about the Fed trying to figure out how to taper without making interest rates go up. But that's impossible to do. right? I mean, the Fed might as well say that they're trying to figure out how to make an omelet without breaking any eggs. See, when the Fed does QE and it buys bonds, it artificially suppresses interest rates. It has to continue to buy bonds to keep those interest rates artificially suppressed. The Fed is trying to figure out how to stop buying bonds, but keep interest rates suppressed, right? They're trying to have their cake and eat it too. One way they're trying to do that is by promising to keep interest rates at zero for a longer period of time, as if those promises will take the place of QE. They won't. They need those promises and QE. As I've said, they're going to need even more QE. That's the fact. Especially if China is going to be taking a leave of absence from these treasury bond auctions. Without the Fed increasing QE, the bond market will plunge, and the Fed knows that the entire foundation upon which this phony recovery rests is its cheap money, is its artificially low interest rates. It likes to pretend that it can have those artificially low interest rates without QE. The reality is it can't. The grim reality that they don't want to admit, but they will be forced reluctantly to eventually admit to it or adapt to it, is that it's going to need even more QE. Now, the Fed is probably not going to be honest as to why there's going to be more QE. They're going to make up some excuse. They'll say, well, the jobs numbers are not quite as good as we would like. Meanwhile, they'll probably look at these phony CPI numbers and claim that we just don't have enough inflation, that there's the danger of deflation is too great. We need an insurance policy against deflation, so the Fed is going to increase the size of QE. But don't worry, this increase is simply a down payment on a taper. We're going to taper. We've got an exit strategy. Yeah, right. They can talk and talk all they want. Eventually, that's the problem. The markets aren't going to buy it. There's only so many times you can cry wolf and have all the townspeople come running to your defense. Eventually, the Fed will have cried wolf once too often, and nobody will buy it. That's when the bottom drops out of the dollar, and then the bond market, and that's when we have the real crash. That's it for now. Everybody enjoy your weekend. Remember, continue to check out my YouTube channel. And for more day-to-day coverage of what's going on, don't forget to tune in to my daily radio show, The Peter Schiff Show, at schiffradio.com. Live show is every weekday from 10 a.m. to noon Eastern Time. Bye for now.